The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday, 3 o'clock. And when we talk about our code, we talk about choice, organization, direction, and education. And we help hundreds of advisors and families and businesses, attorneys and accountants across the United States with our areas of expertise, which are life insurance, annuities, disability, long-term care, and life settlements. And today we were going to talk about a family I'm working with where they've inherited a lot of money and a lot of different complications, and I want to discuss some of the things that have gone on. So, without further ado, let me describe the situation to you. I have a widowed man who passed away and left his family. He has one surviving child, and he has 6 grandchildren. And in his retirement, prior to him retiring, he never really quite retired. Well, actually he did. He sold his business maybe 6 months ago. And for his own retirement, he was buying annuities. You can buy annuities in retirement or non-retirement. So instead of an IRA, he would buy, let's say, a SEP IRA or a self 401k, one of those type of retirement plans. And he bought them every year from different insurance companies. So he probably had 6 or 7 of these retirement IRAs. Now, on these retirement IRAs, he left his daughter and his grandchildren beneficiaries. So a lot of these contracts have 5 separate beneficiaries on these IRAs. Now, what has to happen is, and what we're in the process of doing is, we have to go to each company, and each person that's a beneficiary, it doesn't go by will, it doesn't go by probate, it's a whole other issue. Each beneficiary has to submit a claim form for their benefits. Unfortunately, the insurance companies, the way they work, is they'll send, once they're notified, each beneficiary out forms, and the forms will say, how do you want to take this money? Do you want to take... There's no advice given there. So if they're not sitting down, fortunately, they're all sitting down with me and we're discussing every which one. How do you want this money? Do you want a lump sum? Do you want it this way? Do you want it that way? How do you do this? And if the insurance company receives a form from one person and then another, that will hold up the benefit forever. They'll start a whole new claim and a whole new... So we're trying to put this all together. Now, the interesting thing about this is these annuities, if they take, these are all retirement, these are all IRA annuities. And if you've listened to my show before, you know that with the new law, you can't, it's all taxable to the beneficiary in their bracket. And, you know, a lot of these people, the best way to stretch it out so you don't get taxed all at once is you can stretch it out over 10 years. Now, you can take that income monthly or you can take that annually, but typically we do what they call a 10-year payout annuity. So for the IRS, you're covered. You're taking it out over 10 years. It's the most tax efficient way. The most value you're going to get out of it is a 10-year immediate annuity, which will pay out monthly. Every month you get a check. Now, there's a lot of decisions to make. You want to take that monthly or annually? Do you want to have the taxes taken out? I recommend you take the taxes out as you're getting paid so you don't get a huge tax bill at the end of the year. Now, the other consideration is this may also be estate taxable. So there's other taxes that come into play. There's New York State estate tax and there's federal estate tax with various thresholds. So you don't want to all of a sudden use all this money at once. You got to be very careful because you may get hit with another tax bill down the road. So you have this very careful planning. And in dealing with the insurance company, you want somebody like myself to deal with the insurance company and coordinate how the beneficiaries get paid and where they get paid. He had also purchased non-qualified annuities. Now, what a non-qualified annuity is I use money like CD money or something else, money that's already been taxed, I can buy an annuity with. And why would I do that? Why would I do a retirement annuity? Why would I do a non-retirement annuity or a non-qualified annuity? The non-qualified annuities have the advantage of tax deferral so that I can accumulate money on a tax-deferred basis, which he did, for as long as I want until I use that money. Now, it is subject to withdrawals at a certain point, which he didn't really do any, but that's neither here nor there. There could be some taxes down the road. Now, what many people don't realize, and there's very few companies that even talk about this, is you can do a non-qualified stretch annuity, which means if you inherited an annuity and someone has never taken any money out, the law is the beneficiaries, the grandchildren, in this case the grandchildren and the child, would have to pay tax on any of that gain immediately if they took it out in a lump sum. Although it's not completely taxed like the IRA money, only the gain is taxed. But again, in this situation, do you want to pay that tax plus have future estate taxes now? Or can I stretch that out? And yes, you can if you do an inherited stretch annuity. Like, again, very few companies understand this. When you set these things up, you have to be very specific with the company. The company has to understand whether it's an inherited IRA or a stretch annuity. There's very specific language that has to go into that contract, or the IRS will come in and say, oh, you owe me a ton of money. So it has to be done 100% correctly. So in this case, we have grandchildren and a child inheriting monies, both qualified, which is IRA money, annuities, and non-qualified IRA annuities. So the taxation is different. So we're trying to set up stretch non-qualified annuities and stretch IRAs, which we can only do over a 10-year period. Now, what if one of those children had special needs? Very interesting, because actually he had two grandchildren with special needs. There was a special needs trust set up, but they were not the beneficiary of the special needs. Now, if you have a special needs trust set up, which we talked about a lot, and I can talk about over and over again. It's very important because you need a special needs trust to inherit if a person or a child is not going to be able to work and they need government services, whether it's a daycare or whatever. If they inherit this money straight out, they will be put off government services because they're going to take this money. So the only way to inherit IRA or non-qualified is in a special needs trust. What happens if it's an IRA and it goes to the special needs trust? Very specific language. You want a good attorney who knows what they're doing when you set that up. The trust will still have to take out that money And there still will be a tax, an income tax, in the special needs trust as that money is taken out. Now, if the child or the person is permanently disabled, you can stretch that out over their lifetime. There's rules for that. But if they're not totally disabled, then they might have to take it out over 10 years, and there still would be that income tax as that money's coming out. Very heady stuff. You're listening to the Main Street Code for Financial Success. All I can tell you is, if you're inheriting money, give us a call. There's a lot of implications and tax implications. If you don't inherit properly, you could end up losing a ton of money by not doing it right. You're listening to the Main Street Code for Financial Success. I'm Neil Himmelstein. Best way to reach me is 631-647-4694, and I'll be right back. Welcome back to the Main Street Code for Financial Success. We talk about living an income that you can't outlive, but we also talk about, oh my goodness, we just inherited some money, now what? So the second part of my segment today is, we just inherited money, now what? So there's ways of inheriting money, and there's ways of structuring it so you don't get taxed heavily. There's ways of planning a long time before this happens, but doesn't always happen that way. And, it's great that we inherit money, but you got to be careful, because a lot of times the IRS is waiting in the background for their piece, unfortunately. And if you don't do it right, you could wind up in IRS hell for the rest of your life. So, before the break, we talked about a bunch of people that inherited money. They inherited IRAs and non-IRAs. 5 of the people were grandchildren that were between 20 and 30. So they all had very, very different needs. And then you had a child that inherited money who also has very different needs, who's a parent and has 3 children themselves. So everybody has different needs when they inherit this money. And we talked about the IRA, the stretch IRA, which we do over 10 years. We talked about the non-qualified stretch annuity, which you can take out over a lifetime to avoid paying capital gains on the growth that the non-qualified annuity had, which is wonderful. You don't avoid it. You take it out a piece at a time, which minimizes the effect, and you don't get taxed all at once, and you could spread that gain over a long period of time. You have to take minimal withdrawals, but that's okay. It's not like having to take fully taxable IRA inherited money. Now, this person who passed away also had a business. Now, they sold their business right before passing away. Now, let's talk about various scenarios when you sell your business. You can sell your business and get all the money at once. You can sell your business in this situation where there's an income stream coming in for several years as a payoff to your business, which is how this was done. Now, it could have been done several different ways, but what's interesting is, if it were done this way, I had an idea. So if it were done where the child was getting an income for several years to pay for the business from the business income, even though they have no ownership in the business, which is the way I would have done it before I sold it, but that's just me. But if they were just the sole inheritor and they were getting income, one of my recommendations was going to be, why don't you set up your own company to receive that income? And the reason being is you're getting income from various sources now that you never did. And maybe you could set up a retirement program as a business and write off some of that money so that you don't get killed in taxation. So being tax efficient is very important in planning, and life insurance and annuities are most tax efficient tools. But again, you have to plan it out properly. Now, with the children that are inheriting IRA money and a non-qualified stretch money and other monies, my conversation's a little different because I want to talk about long-term income streams. if I'm only taking money for 10 years, and like I said, I recommend monthly, not annual, and I recommend you take the taxes out so you don't get hit with a surprise at the end of the year. And by the way, that adds to whatever that child is making. If they're making whatever it is, $50,000, $100,000, $200,000, whatever it is, whatever money they get out of that IRA, which they have to take over 10 years, will add to their income tax bracket, whatever their bracket is. So if they're not paying any taxes now, all of a sudden they're going to be paying taxes. If they're in a 15% bracket, they now may be in a 24% bracket and have to pay taxes on their income additional to there's a lot of planning goes in here. So if you take the money out over 10 years, what happens year 11? All of a sudden you're getting used to all this money coming in, and you don't have a plan for year 11. Now, if you're one of these silly people that inherit the lottery and they buy a house and then don't account for paying the taxes and go bankrupt in 2 years, which happens all the time, then it's going to happen. But if you plan it out right, you can live a great life and have income for later on down the road. So one of my suggestions would be, and is going to be after the smoke clears, is to create an income stream in year 11. How do I do that? Well, with some of the non-qualified money that they're getting in the stretch, I'm going to suggest it get reinvested in life insurance. Now, what does that do? That's going to set these kids up for the next generation. So now we're going 3 generations down from the grandfather. As they buy this insurance, whether they're married or single or whatever else, the beautiful part about the life insurance I'm going to suggest is going to be high cash value life insurance where they can take it out in year 11 as another income stream. They don't have to, but they can. So that after the income of all that IRA ends in year 10, year 11, now we have a new income stream that's 100% tax-free. It's crazy. This is perpetual income for the rest of your life. And that's going to be my suggestion in the planning tool. So the planning tool for the daughter was open up a separate business. So all these different planning tools we have at our disposal. Here's the problem that everyone runs into. In this situation, they're going to be dealing with lawyers for a long time. Why? Because not everything was set up right, just like the annuities, which we can take care of, and the life insurance we can take care of. And there was a pension as well. Now the pension, they said, has no beneficiary. Not sure about that. I'm sure lawyers will have to fight on that one. It was not in an annuity, but a lot of pensions don't have a beneficiary. You have a spouse who's a beneficiary, then there's a lot of weird things with beneficiary law and taxation. So the pension didn't have any, but there's other monies there. I mean, there's a lot of things at play here. It's just a lot of planning, and planning is different for the parent and the child. Obviously, they have different needs. They have different time horizons. They have different, what do we do? How do we set things up? How do we do things for our kids? So maybe for the kids, we set up another income stream for them down the road. For the parents, they're more concerned about protection for their children. And if they have special needs, we might want to set up a policy for a special needs trust. So all kinds of great plans. The problem is this. You're going to go to an attorney, and hopefully you use a trust attorney who's going to sort all this stuff out. All the other stuff. The life and annuities I sort out. And they're going to be sorting it out, and the accountant is going to be doing what accountants do. Some of them are just tax preparers, and a lot of them aren't planners. They're going to say, okay, what's the cost of this, and and they'll figure out your taxes. But you need somebody like myself to really plan things out as to when you're going to get money, when you're not. I'm not a CPA, and I'm not an attorney. But you need that glue. The Knicks, they need that glue guy. They need that Josh Hart, right? I'm the glue guy in your financial planning. You need the glue guy who does a little bit of everything, who understands how all the parts work together And that glue guy can communicate with your attorney and your accountant to guide them as to how the assets should be distributed and received. They can figure out how much taxes you have to pay and go through all the legal stuff. The accountant can be the bean cutter, So not everybody's understands all the integral parts. You need the glue guy. I'm the glue guy. You're listening to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. Give me a call, 631-647-4694. Go Knicks. All right, we'll talk to you soon. Thank you. Have a great weekend.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.